Welcome to TheoTrade. This is Don Kaufman doing the weekend update. It's June 25th, 2016. First, we state the obvious. We've had what appears to be the beginning of a major volatility event in the markets. The S&Ps obviously hitting what's called lock limit in the overnight trade on Thursday. If you're not aware of what limit down happens to be, it's a 5% move in overnight trade of the futures. Nevertheless, the S&P is closing down just about 4% on the trading session. Now, what I'm going to attempt to do in a short time over here is, again, let's not rehash the obvious, right? We hit a pretty serious volatility event. Is it the beginning? What can we actually expect over here? We're going to go through a couple of odds and ends, and what I feel is most critical and most important. First is going to be containing your risk. Secondary is going to be taking advantage maybe of some of the coming volatility. All right, so let's start it off with this. S&P's down fairly big. Volatility does take off. However, when you want to put this in some perspective, when I say volatility, a lot of people are going to refer to the VIX. So we'll start over there. And we'll take a quick glance at the VIX. Now, again, I'm not much of a VIX individual. Nevertheless, just taking a quick glance at the VIX, you're like, all right, so it spiked up to 25. Now, that's 30-day out volatility, spikes up to 25. And again, this is the obvious, but what you have to start to rationalize is looking at the VIX in 9 months just isn't going to do it justice. You got to back out the chart over here, because the event that we've had, and that's the events that are going to continue to unfold, are much more drastic than some sell-side activity that we saw back in like January, February on just a little bit of fear, of recession in the economy that spiked some of the volatility. Granted, you also have to recognize, if you want to zoom in here at the front of the year, okay, specific to dates over here, this is when the S&Ps were down at what? 1,800. You look at the S&Ps, and overall, yesterday, being Friday, markets didn't fare half bad. Yeah, okay, you're like, but Don, the S&Ps, the SPX is down, 3.6%. Yeah, and it didn't fare that bad. Did you look at markets around the world? 8% off here, 7% off in Germany, and on and on. Generally speaking, we didn't fare half bad. Now, again, to throw perspective on there, you got to be aware of volatility. It hasn't but awoken at this point. And again, to throw some broader perspective, look at like a 5-year, okay, in terms of volatility, and you start to look at events, and you're like, well, and even back here, okay, this is 2011. This is the VIX up in the 40 level, all right, and you want to get even more, a little crazy. Let's get crazy. You come back over here, like 60 volatilities. An event such as that unfolded, okay, this volatility, allow me to be the first to tell you, this is here to stay, okay? For the foreseeable future, this is not going to be a one big down day event, and that's exactly what we're going to explain. So first, let's talk about risk mitigation, okay, and why we're going to see a lot more volatility. This is not an if, and, or but. We are in and going to see substantially more volatility at this point. If you've been listening to some of the videos over the last couple of weeks, I have noticed drastic movement in what's called the VVIX well before, okay, the British exit vote over here. And I said volatility looks just inherently low, okay, and that's when the volatility was increasing. Right now, forget that the VVIX even exists. It doesn't matter. We're already in the throes of volatility. This isn't a warning sign anymore. It doesn't do anything for us. Forget about it. Now we got to start looking at our volatility futures. Now these we haven't brought up since January, February time frame and really looked at this in depth. Okay, here's what you need to know of why there's going to be continued volatility. Okay, here we actually have July volatility futures. There's ultimately 25 days left. Out a little bit further, forget about all this weekly garbage, right? Look a little bit further out in time over here, and we get what? We get the August volatility futures. So this is what people talk about with like contango and backwardation. It's like buzz terms in the industry. The bottom line is short duration volatility. As of right now, when I say short duration volatility, here the 25-day volatility is sitting at 22.65. Okay. Further out in time, 53-day volatility is sitting at 22. Okay, 14. They've actually inverted. That means the risk in the near term is actually higher than the far term. But again, to throw it into perspective over there, it's still nothing. I've seen volatility inverted by 3 or 4 points. That means the 25-day volatility futures, this thing can get much steeper than it currently is. And what actually surprised me about the down move yesterday is that volatility, it increased substantially in all, the future, which ultimately denotes here we go. And that means the entire marketplace is pricing risk to be drastically larger, even way out into future expirations. But we're still only in the vol futures, 22.65. Okay, that's like a slap on the wrist. When the volatility futures are inverted like this, here's what you really need to know. All right, when you see short duration volatility futures, and look at the monthlies, the 25, all right, 25 days, 22.65. If they're above the 53-day, sell every rally. In a marketplace like this, okay, there is, and the volatility futures are inverted like they are, there is no chart that tells you anything. Okay, this is where, again, block out any of the media. Well, there's going to be a domino effect in Europe. Who cares? Who cares? It's not going to help you make money at this point. It's not going to help you save money. What is actually going to help you is an understanding of the sheer magnitude of the volume going through. I'll go to the S&P futures to denote this and show you why there is nothing that's going to give you a feel for direction. Look, 4 million S&P futures contracts traded. Okay, when you get 4 million contracts traded, that's everybody, all hands on deck, fire at will. There is no rhyme, no reason. You're in the hands of algorithms at this point. We start to get dynamically hedging out of control. That means the algorithms start firing off, and professional trading firms have to sell into the down move. Why? To mitigate their risk. Now, mark my words over here. You see this low, okay, of 1999? That low right there of 1999 was the lock limit. What that predominantly means in the futures contracts is that most of the professional trading firms have a hedge on right now all the way down to that level. Wait for it. Yeah, we're really trying to get right back down to the 2000 level. Coming into Monday, Tuesday, and Wednesday of this week, let's start to, again, work our way forward here into the actual trading week. We're still going to see extreme volatility. When you see a rally, this is what we term the rip your face off rally. Complete and utter chaos will be abound in the market in the first couple of days of the week. What we saw on Friday was rather orderly. Okay, coming into Monday, well, now it's been all over the news and all over the media. What's going to exacerbate the risk on Monday, Tuesday, Wednesday is, number one, we're coming into a holiday week. July 4th is just around the corner over there, so people are going to let fly coming into the beginning of this week. The other thing that's really going to exacerbate the risk is, right now, as we speak, do you not think that every central banker is meeting? You've got Mario Draghi meeting with the ECB, okay? Guaranteed Janet Yellen is on the phone over here with all of them. They're going to try to orchestrate something and probably have a press release that, again, is just going to exacerbate the risk. So what are they going to do over in Europe? The ECB, that's the European Central Bankers. All the central bankers. Japan has got serious issues. Why do they have such issues? Well, number one, the markets are falling. But really their issue is the currencies are out of control. Currencies are completely out of control right now. That kind of volatility, extremely unpredictable. They're going to try to, well, let's say, put a tourniquet on some of the bleeding over here. Unfortunately, it might be throwing a Band-Aid into a very large gaping hole in this marketplace, which brings me again to another point. Early in the week, look for rather extreme volatility. At this point, with the volatility futures inverted, sell the rallies. Okay, the rallies are going to be fierce. Now, before I go any further, and I don't want to miss this point, when you're in the midst of volatility like this, and again, 15 years I had at a brokerage firm watching order flow. One of the things I want to do is save your capital. I was going to say but we'll save your capital out there. Do not put in any good till canceled orders. Get rid of them. I don't care what the good till canceled order is for, but Don, I got to get out. I don't care. Get rid of the good till canceled orders. Get rid of any market orders. Get rid of any stop orders. If they're in there, you're going to get ripped apart in this. Why? Wide bid offer spreads. Okay, at the open alone the other day, you'd have gotten stopped out. And some of you listening to this didn't, kind of feel that warning that we gave on Friday specifically about that. You got stops in though and so forth. Clear them out. Get rid of your stops. Get rid of your good till canceled. All right. If you need to sit there and set alerts, set alerts. Alert yourself and get out. Physically click the button to be able to get out, because right now the only thing you're going to do is get ripped apart in the volatility. Why do I say that? All right, let's go to the SPX once again. Forget about individual stocks. They're neither here nor there. They're going to be pawns in the greater scheme of what the S&P futures and the broader market are going to do. Think about it. Okay, they're going to be pawns. Sure, the financials are getting smoked over here, but they're going to fall in accordance with what the market's going to do. It's about correlations. When markets, are in extreme volatility, it's about 95% correlations. That basically means doesn't matter where you go to hide, they're going to hit them all. 95% correlation with the S&P 500 in the midst of volatility. Now, the SPX this coming week is going to help us out. Why? The SPX has an expiration for what? Wednesday, Thursday, and Friday. Now that's good stuff. Why? It's giving us details of expected move on each day. This is some of the highest volatility we've seen since all the way back. Yeah, you got to go back to August of 2015 to see volatility this pumped up in the short duration. So vol, it's like the VIX of the 4-day, the VIX of the 5-day, the VIX of the 6-day. And the cool thing is, again, there's expirations 3 times next week. It's literally like daily options, a 4-day, a 5-day, a 6-day, because there's an end of quarter, then there's a Friday, and there's always a Wednesday now. So it gives us very definitive risk metrics over here. Volatility is going to be rather unstable. Now, again, you're looking at about a 70-point expectation of movement between now and next Friday. But I feel most of that's going to fall in the first 3 days of the week. Coming into Friday, everybody's going to be exhausted, and they're like, that's it! I'm going on vacation! We're going to the Hamptons! So you got to look for a better part of a $70 expected move. Now, that's expected. That's normal. You also got to take that expected move and double it. Why? That's what we call the probability of touching. You do realize we are looking right now at $140 moves inside of the S&P in, this week of trading. It's going to get real out there, and you better be willing to sustain the risk. So take a look at all of your positions this weekend. This is not to scare you, okay? This is to tell you you should be scared already. If you're not feeling the fear, okay, you're not awake yet. We're down 4%. And people, well, I could buy some puts. You're going to buy puts in some of the highest volatility we've ever seen in recent history, okay? Volatility can get a lot worse. If you need to lighten the load of your positions, go look at your monitor tab. You need to lighten the load of your positions, then do it. But don't sit there and do nothing. This is not a deer in the headlights kind of time. Now, continuing on over here. Remember, forget the VVIX. It's done already. You got to look at the volatility futures. As long as the volatility futures remain inverted, that is short duration over long duration, sell rallies. I know everybody else will be selling those rallies. Okay. Here is also why I feel there's going to be continued volatility. So the British exit, again, it happened. It's no longer news. What is going to be news is political uncertainty. Not going into the politics of it. Don't care, don't want to know. Okay, I turned on the news for 5 minutes last night, turned it off, and was kind of laughing about it because they're projecting who's going to leave next. Is it going to be, Ireland? Is it going to be what? Spain? It's going to be exits. The dominoes are going to fall. Doesn't matter. The things that you need to know that will matter, okay, for your portfolio, this is investments or trading. It's a very simple idea. Currencies are ripping all over the place. So we're going to look at the dollar futures, and I don't talk about currencies too often. Okay, it's not that I'm not a currency guy, but currencies are going to be all over the place. Do you have any idea what that's going to do to a company like, let's say, Apple? What does Apple charge for a song like on iTunes? And I'll just give you the most simple example. They're like, well, they charge 99 cents. Yeah, that's here. What are they going to charge in Europe next week? I don't know. Neither do they. How do you stem that currency risk? You don't. The best hedgers in the world can't get ahead of this. Corporate earnings are going to be all over the place. The irony is some companies are probably going to perform extremely well. It depends on where their business is centralized. Again, you look at a company like Apple, a very international firm. Europe, all over the place. Again, the currency dives over there. The U.S. currency goes up. It hurts exports, but for the other companies, it may actually help them. The bottom line is they're going to get ripped apart with currency risk, which, if I was a CEO, or CFO, this weekend, I'd probably be talking about one factor. Tighten down right now. Tighten down everything, slow spending. We got to see how this plays out. This is the kind of move. Listen, this is one bad day in the market. It's the kind of move that can cause a recession overnight. It's because they're going to tighten corporate spending. They don't know what to do. You don't know what to expect. Believe me, a CFO or CEO, they don't know what to expect either. And the first thing they may do to tighten corporate spending, number one, they're not going to spend that much. Number two, corporate buybacks. Let's not dump our cash just yet. We might need that cash because we could be in trouble over here with currency risk. Think about it. That is going to be the real reality in just the next couple of months. Beyond that, come on, there's no clarity whatsoever. All we know at this point, we threw off one good day of volatility. Currency risk is all over the place. Again, the VIX is just awaking. I mean, it's just, wake up. All right, it's a 25 over there. When you look back, though, to much more serious situations, the VIX getting into the mid-30s, well, that gets more entertaining, right? Again, this coming week, watch the rallies. The rallies are going to be the most violent. The other thing, know where limit down happens to be. That's a scary concept. What's limit down? It's when the futures lock up overnight. Limit down is a 5% move, from the previous day's close, 5% move overnight. There's actually links to it that we'll have all over our chat room here at TheoTrade to be able to see where limit down is. It's a 5% move overnight. When trading opens, 7% is the first limit down. 7% move. It's pretty drastic. 7% move hasn't happened since August of 2015. They'll lock them up for a few minutes, down 7%. After a few minutes, what does it mean when they lock them down? You can only be a buyer, you can't be a seller of futures, but futures drive order flow. After a few minutes, they unlock them. Then we can drop down 13%. From there, it's utter chaos. But you have to really consider this, seeing that in the first move, we already saw a limit down event of 5%. Again, overall, I believe on Friday, the markets fared extremely well. Things were rather orderly, give you time to get out. Remember, cancel all open working orders. Don't be putting market orders out there because you're going to get filled at the worst possible price of your life. Hopefully, this didn't happen to you already on Friday. With that, we're going to see how the markets are going to open on Sunday afternoon. Again, chaos is abound. If you see the rally over there, you don't buy into it. What happens in dynamic hedging? You get heavy sell-side activity. The shorts got to cover. It'll pop us higher. And for right now, the traders are going to play whack-a-mole. Every time we rally, they're going to sell into it. Don't get caught in the crossfire over here. Start recognizing the signs of volatility. They're going to be here for a while. Sure, it might get a little dull during July 4th, or right there in and around, maybe by Friday. The front of this week, though, could be nothing less than spectacular. 100-point plus moves could become a bit of a norm in the S&Ps in the short duration. That could also be to the upside. Nothing is going to display what we move to. All you can do at this point, pick a level and smile. That's it. When I say pick a level and smile, whether higher, whether it's lower over there, I personally will maintain my short positions. I covered slight amount of risk over here, but generally speaking, I'm sticking with being short about 5,000 spider deltas, and I'll stick with that and maybe start to cover some risk as we make these moves. Again, an explosion to the upside is just as likely, though, as a wild down move. However, traders, again, they're going to fade these rallies. Thanks everybody for joining us here at TheoTrade.